Silver just hit an all-time high, and what's happening next could shock the entire financial system. Some analysts are now openly talking about $150 silver. Is this hype, or are we standing at the edge of a historic breakout? Watch till the end, because what I'm about to show you is not being discussed on mainstream media. I'm recording this Wednesday, January 28th, 2026 at 5 a.m. in New York City. Drop a comment and tell me what time it is where you're watching from. I'm genuinely curious who's here with me at this hour and who's catching this later. And a quick note before we continue. The analytics show a huge number of you watch these breakdowns consistently, but still haven't subscribed. If you're getting value from this kind of macro perspective, hit the subscribe button. It helps support the channel more than you probably realize. When silver breaks an all-time high, it is never just a technical event on a price chart. It is a psychological rupture in the financial system. All-time highs represent levels where every previous buyer in history was once underwater. When price moves beyond that zone, it erases collective memory of loss and replaces it with something far more dangerous for the system: confidence. Confidence in the asset and doubt in everything priced against it. Silver crossing that threshold signals that the market is no longer debating value. It is accepting repricing. Historically, silver does not behave like equities or even gold once it clears long-term resistance. It does not grind upward in orderly increments. It accelerates. This is because silver is both a monetary metal and an industrial necessity, trapped in a uniquely tight market structure. When confidence shifts, there is no deep pool of available supply waiting to absorb demand. Instead, buyers begin competing with one another, and price becomes the only release valve. That is why silver's most important moves have always happened after the breakout, not before it. An all-time high in silver also represents the failure of suppression narratives that have existed for decades. For years, silver has been dismissed as too volatile, too small, too manipulated to be taken seriously as a monetary signal. But manipulation only works in markets where participants still believe in the paper system. Once price escapes the historical ceiling, that belief starts to fracture. Every institution that sold silver short, assuming it can't go higher, is suddenly forced into risk management mode. And forced risk management creates forced buying. This is where silver becomes dangerous for the broader financial architecture. Unlike stocks, silver does not represent future earnings. Unlike bonds, it does not promise yield. Silver represents something far more threatening: a vote of no confidence. When silver breaks to an all-time high, it is not rallying because of optimism. It is rallying because participants are quietly hedging against systemic failure. Currency dilution, sovereign debt instability, and long-term inflation expectations are being priced in through a metal that cannot be printed, cannot be diluted, and cannot be engineered away. What makes this moment different from past rallies is the backdrop against which it is occurring. Previous silver highs happened in environments where central banks still had credibility. Interest rates could be raised, balance sheets could be shrunk, confidence could be restored. Today, those tools no longer function the same way. Global debt levels are too high, fiscal deficits are structural, and political systems are increasingly unable to tolerate economic pain. When silver breaks an all-time high in this environment, it is doing so without a credible policy backstop. There is no easy reversal lever. Another critical factor is memory. Markets remember trauma. The last major silver peak created fear, embarrassment, and skepticism that lasted over a decade. That skepticism kept capital sidelined and suppressed interest. But once an all-time high is breached again, that trauma flips. Fear of loss becomes fear of missing out. Capital that ignored silver suddenly has to justify its absence. Portfolio managers, funds, and even conservative investors begin asking the same question at the same time: why don't we own this? That synchronization is what creates nonlinear moves. An all-time high also exposes a lie embedded in the pricing of modern money. If currencies were stable, if purchasing power were preserved, if inflation were truly contained, silver would not need to reprice higher. Its breakout is a quiet audit failure of fiat systems. It is the market admitting, without headlines, that value is being destroyed elsewhere. Silver does not celebrate, it warns. This is why all-time highs in silver are rare, and why they matter so much when they occur. They are not endpoints. They are starting lines. They mark the moment when disbelief ends and repricing begins. And historically, once silver makes that transition, the move that follows is not measured in percentages, but in multiples. Silver's price cannot be understood without confronting a reality most investors ignore. The supply side of the silver market is structurally broken. This is not a temporary imbalance, not a cyclical shortage, and not something that can be solved with higher prices alone. Silver supply is constrained by geology, economics, and time, and all three are now working against the market simultaneously. When demand accelerates under these conditions, price does not rise gradually. It gaps higher, because there is nothing elastic on the other side to meet it. Unlike gold, silver is not primarily mined for itself. The majority of silver production comes as a byproduct of mining for copper, lead, zinc, and gold. That means silver supply does not respond directly to silver prices. Even if silver doubles or triples, miners cannot simply turn on more silver production unless base metal mining also expands. And base metal expansion depends on global growth, capital investment, permitting, energy costs, and political stability, none of which are currently aligned for a rapid increase in output. At the same time, silver ore grades have been declining for decades. Mines are extracting less silver per ton of rock than they did in the past, which means higher costs, more energy usage, and diminishing returns. This creates a ceiling on how much production can realistically be increased, even with higher prices. Mining companies are already struggling with inflation in labor, fuel, and equipment. The idea that silver supply can suddenly surge to meet demand ignores the physical and economic limits of extraction. Compounding this issue is the collapse in new mine development. Bringing a new silver mine online is not a short-term project. From discovery to production can take 10 to 15 years, assuming no regulatory delays, environmental opposition, or financing disruptions. In the current environment, where capital is expensive and governments are increasingly hostile to resource extraction, fewer projects are being approved, not more. The future supply pipeline is thin, and that weakness is already baked into the next decade. While supply is rigid, demand is becoming relentless. Silver is no longer just a store of value or an investment metal. It is a strategic industrial input. Solar energy alone consumes massive quantities of silver, and global energy transition policies are accelerating that demand regardless of price. Electric vehicles, advanced electronics, data centers, medical technology, and military systems all require silver for its unmatched conductivity and reliability. Unlike investment demand, industrial demand does not disappear during volatility. Manufacturers cannot substitute silver easily, and in many cases, cannot substitute it at all. This creates a dangerous feedback loop. As prices rise, investors move in, expecting higher prices. As investors move in, physical inventories tighten. As inventories tighten, industrial users begin securing long-term supply, pulling metal off the market preemptively. This hoarding behavior is rational from an operational standpoint, but catastrophic for price stability. It removes float from an already tight market and accelerates upward pressure. What makes this moment especially critical is that above-ground silver inventories are far smaller than most assume. Unlike gold, which is hoarded and rarely consumed, silver has been used up for decades in industrial applications and lost to landfills, products, and unrecoverable waste. Much of the silver mined in the 20th century no longer exists in investable form. The notion that large hidden stockpiles will suddenly emerge to cap prices is largely a myth rooted in outdated data. When a market with inelastic supply collides with non-negotiable demand, price becomes the only balancing mechanism. There is no policy lever, no production surge, no quick fix. This is not speculation driving scarcity, it is scarcity driving price. And once that dynamic takes hold, it tends to overshoot because markets are forward-looking. Buyers do not wait for shortages to appear on paper, they act in anticipation of them. This is why silver supply dynamics matter more now than at any point in modern history. The system has quietly assumed that silver will always be available, always affordable, and always subordinate to paper pricing mechanisms. That assumption is now being tested. If it fails, the repricing will not be polite. It will be sudden, disorderly, and impossible to reverse quickly. And in markets like silver, once the supply story breaks, it does not get fixed. It gets exposed. The silver market is not priced by physical metal. It is priced by paper promises. Futures contracts, unallocated accounts, ETFs, and derivatives set the global price of silver, even though only a fraction of those claims can ever be fulfilled with real metal. This structure works only as long as participants trust that paper silver is as good as physical silver. The moment that trust weakens, the system does not bend. It snaps, and rising prices are exactly what apply that pressure. For decades, the paper-silver market has expanded far beyond the underlying physical supply. Each ounce of silver sitting in a vault has been sold, leased, rehypothecated, and promised multiple times over. This leverage suppresses volatility during normal conditions, but it creates extreme fragility during stress. When prices rise sharply, the imbalance between claims and reality becomes impossible to ignore. Suddenly, holders of paper silver start asking the wrong question for the system. Can I actually get the metal? As silver moves into all-time high territory, that question becomes contagious. Large investors, institutions, and even sovereign entities do not want exposure to price alone. They want certainty of delivery. This is where cracks begin to form. Exchanges allow cash settlement, ETFs allow redemption only under specific conditions, unallocated accounts promise silver without identifying where it is stored or whether it exists at all. These mechanisms function smoothly when nobody demands delivery at scale. But history shows that rising prices incentivize exactly that behavior. Once enough participants demand physical settlement, the market faces a problem it cannot solve quietly. Either metal must be sourced at higher and higher prices, or contracts must be settled in cash, effectively admitting that the paper market is decoupled from physical reality. Both outcomes undermine confidence. One drives prices violently higher. The other exposes the system as fractional. Neither is stable. What makes silver especially vulnerable is its size. Unlike gold, the silver market is small, thin, and easily overwhelmed by relatively modest capital flows. It does not take trillions of dollars to stress the system. It takes a shift in behavior. When industrial users, mints, investors, and funds all move toward physical at the same time, available inventory evaporates. Premiums rise first. Then delivery times stretch, then price gaps appear that no technical model can explain. This is why paper-silver suppression works only in low volatility environments. The moment volatility returns, leverage becomes a liability. Short positions that were safe under stable pricing become existential risks when price accelerates. Margin calls, force buying. Forced buying drains inventories. Drained inventories expose leverage. The cycle feeds on itself. This is not theoretical. It has happened before, just never at this scale and never against this macro backdrop. Another critical factor is visibility. In the past, physical tightness could be hidden. Today, inventory reports, delivery notices, and physical shortages circulate instantly across global markets. Retail investors notice when coins disappear. Industrial buyers notice when suppliers delay. Large players notice when vault levels decline week after week. Transparency accelerates loss of confidence, and confidence is the only thing holding the paper market together. The most dangerous phase for the system is not the first price spike. It is the moment participants realize that paper exposure carries counterparty risk. At that point, price no longer matters as much as possession. A market driven by possession behaves very differently from one driven by speculation. Sellers disappear. Buyers pay whatever is necessary. Price stops reflecting balance and starts reflecting scarcity. If the paper-silver market were fully backed, rising prices would be inconvenient but manageable. But it is not. It is built on rollover, settlement flexibility, and the assumption that most participants will never ask for delivery. All-time highs challenge that assumption directly. They turn passive holders into active claimants, and when too many claimants show up at once, the math fails. This is why a true silver breakout is not just a rally. It is a stress test of financial plumbing that was never designed to be tested. The higher silver goes, the more pressure is applied to a system that depends on belief rather than metal, and once belief breaks, no amount of paper can substitute for something that is suddenly, visibly, and undeniably scarce. Inflation is often discussed as if it were a temporary visitor, something that arrives unexpectedly and can be politely shown the door with the right policy decisions. That narrative is convenient, but it is fundamentally misleading. Inflation is not a short-term event, it is a process. And in the current global system, that process never truly stopped. It only changed how it was measured, where it appeared, and who was forced to absorb it. Official inflation statistics suggest stabilization, even improvement. But these numbers are constructed through models, substitutions, and assumptions that do not reflect lived reality. When the cost of essentials rises faster than wages, purchasing power is being destroyed, regardless of what the headline figures claim. Food, energy, housing, healthcare, and education continue to rise in ways that cannot be dismissed as temporary distortions. Inflation did not retreat, it embedded itself. This matters because silver does not respond to reported inflation, it responds to monetary reality. When currencies are expanded faster than the production of real goods and services, value is diluted. That dilution may not show up immediately in consumer price indices, but it always emerges in asset markets and hard goods. Silver has historically been one of the earliest and most sensitive detectors of that imbalance. It does not wait for official confirmation. It front-runs it. The global debt structure ensures that inflation cannot be meaningfully defeated without causing systemic damage. Governments are trapped. Raising interest rates enough to truly suppress inflation would destabilize sovereign debt markets, crash asset prices, and trigger political backlash. Lowering rates, on the other hand, reignites inflationary pressure. This is not a policy error. It is a mathematical constraint. Debt levels are so high that inflation becomes the least painful option available. Central banks understand this, even if they cannot say it openly. Inflation allows debt to be serviced in devalued currency. It transfers wealth silently from savers to debtors, from the public to the state. This is why inflation is often tolerated, redefined, or reframed rather than eliminated. And this is precisely why silver matters. Silver sits outside that system. It cannot be diluted by decree. It cannot be redefined by statistical adjustments. When inflation becomes structural rather than cyclical, investment behavior changes. Investors stop asking how high interest rates will go and start asking what preserves purchasing power over time. Bonds lose appeal. Cash becomes a liability. Real assets begin to reassert themselves. Silver thrives in this environment not because it generates yield, but because it resists erosion. It is not a bet on growth. it is a defense against decay. Another critical shift is expectations. Inflation is as much psychological as it is monetary. Once individuals and institutions believe that prices will continue to rise, behavior adapts. Spending accelerates, hoarding increases. Long-term contracts are repriced. These actions reinforce inflation regardless of central bank intentions. Silver benefits from this shift because it sits at the intersection of monetary hedging and industrial necessity. It is both protection and input, making demand resilient even when economic conditions weaken. What makes the current inflationary backdrop especially potent for silver is its global nature. This is not confined to one country or one currency. Competitive devaluation, fiscal expansion, and political pressure on central banks are widespread. When all major currencies are being diluted simultaneously, relative value becomes meaningless. Investors are forced to look beyond fiat comparisons and toward absolute stores of value. Silver re-enters that conversation naturally. Inflation also exposes inequality in a way that destabilizes confidence. Asset owners benefit, wage earners fall behind, trust in institutions erodes. This social dimension feeds back into markets, increasing volatility and demand for perceived safety. Silver has historically performed best not during periods of calm inflation, but during periods when inflation collides with social and political stress. Those conditions are no longer hypothetical. The idea that inflation is under control rests on the assumption that credibility remains intact. But credibility is fragile. It is lost gradually, then suddenly. Silver rising aggressively is often one of the earliest signs that the public is no longer fully convinced. It is not reacting to tomorrow's inflation report. It is reacting to the realization that purchasing power is being systematically sacrificed. In that context, silver's move is not speculative. It is defensive. It reflects a growing understanding that inflation is not an emergency to be resolved, but a condition to be managed indefinitely. And in such an environment, assets that cannot be printed, restructured, or politically adjusted do not merely rise in price. They are revalued. The idea of $150 silver sounds extreme only because most people are anchored to a price system that has already radically changed. When prices feel unbelievable, it is usually not because the asset is expensive, but because the unit of measurement has been quietly degraded. To evaluate whether $150 silver is realistic, the question should not be framed emotionally. It should be framed mathematically and historically. When you do that, the number stops sounding sensational and starts sounding inconvenient. Silver has spent much of the last decade priced as if monetary expansion were temporary, industrial demand were optional, and financial stability were intact. None of those assumptions are true anymore. The global money supply has expanded at a pace never seen outside of wartime, while silver supply has remained constrained. Historically, when money supply growth and silver availability diverge to this extent, price does not adjust gently. It rebalances violently, often overshooting before stabilizing. One of the simplest ways to understand silver's potential is through its historical relationship with gold. For centuries, silver traded at a much tighter ratio to gold than it does today. At various points in history, that ratio ranged between 10:1 and 20.1. In the modern era, it has been stretched far beyond that, sometimes exceeding 80.1 or even 100.1. Those extremes did not persist because they reflected fair value. They persisted because silver was structurally suppressed and ignored. When silver mean reverts, it does not drift back, it snaps back. If gold merely holds its value and silver returns to even a conservative historical ratio, triple-digit silver prices become a logical outcome. This does not require gold to explode higher. It requires silver to stop being mispriced. And mispricing can persist for long periods, but it never resolves slowly once confidence breaks. Markets correct distortions decisively, not politely. Another way to approach the $150 question is through inflation-adjusted comparisons. Silver's nominal highs in the past occurred in monetary systems that were far smaller than today's. Adjusted for the expansion of currency, credit, and debt, silver has not come close to matching its historical purchasing power. When analysts say silver is near all-time highs, they are referring to nominal charts, not real value. In real terms, silver remains deeply discounted relative to the scale of monetary dilution that has already occurred. Critics often argue that high silver prices would destroy industrial demand, making such levels unsustainable. That argument misunderstands silver's role in modern industry. In most applications, silver represents a small fraction of total production costs, but a critical component of performance. Manufacturers do not abandon silver because it is expensive. They secure it because it is irreplaceable. At higher prices, demand may become more disciplined, but it does not disappear. What changes is who can afford certainty of supply. It is also important to recognize that markets do not move linearly toward fair value. They move in waves driven by psychology, leverage, and constraint. When silver begins to move aggressively, it attracts capital that previously ignored it. That capital does not enter at the bottom, it enters once price confirms momentum. This creates reflexivity. Rising prices attract buyers, buyers tighten supply, tight supply accelerates price. In such phases, targets are not ceilings. They are milestones. The $150 level does not imply a stable equilibrium. It implies a period of stress, repricing, and imbalance. Historically, silver's largest moves occurred during moments when financial systems were under strain, trust in currencies was weakening, and policy responses were constrained. Those conditions are not hypothetical today. They are observable. The question is not whether silver can reach such levels in a perfectly functioning system. It is whether the system remains functional enough to prevent it. Perhaps the most important point is this: markets do not wait for permission. They do not require consensus forecasts or official validation. When conditions align, price moves until it forces recognition. If silver reaches levels that appear irrational, it will not be because silver is broken. It will be because the framework used to value it is. Seen through that lens, $150 silver is not a prediction. It is a stress scenario. It represents what happens when suppressed price, constrained supply, expanding money, and shifting psychology converge. Whether that level is reached or exceeded is ultimately less important than what it would signal: that the market is no longer pricing silver as a commodity, but as a measure of monetary reality. When silver truly begins to run, it is never an isolated market event. It is a signal that something deeper is failing beneath the surface of the financial system. Silver does not lead economic cycles the way equities do, and it does not react to optimism or growth narratives. It responds to stress, imbalance, and loss of trust. That is why sustained, aggressive moves in silver have historically appeared near moments of systemic transition, not at the beginning of stability. A powerful silver rally forces uncomfortable questions onto policymakers and institutions. Unlike stock market rallies, which can be celebrated as signs of confidence, a silver surge is difficult to spin positively. It suggests that capital is seeking refuge rather than opportunity. It implies that investors are prioritizing preservation over growth. This shift is deeply threatening to a system that depends on perpetual expansion, leverage, and confidence in paper claims. As silver prices accelerate, the first cracks appear in currency credibility. Currencies are built on belief, reinforced by policy discipline and trust in institutions. When silver rises sharply, it exposes the erosion of that belief. People do not flee to silver because they expect prosperity. They move to silver because they are hedging against dilution, instability, and policy failure. This quiet vote of no confidence does not show up in official statements, but it is visible in price. Central banks are particularly sensitive to this signal. A rapidly rising silver price complicates monetary policy by highlighting the consequences of prolonged accommodation. It limits the ability to ease aggressively without reinforcing inflation expectations. At the same time, tightening policy to defend currency credibility risks destabilizing debt markets and triggering recession. Silver running higher compresses the policy space until there are no painless options left. The impact does not stop at currencies. Bond markets begin to reflect rising risk premiums as inflation expectations become unanchored. Equity valuations become harder to justify as discount rates rise and real returns are questioned. Confidence in long-duration assets weakens. Silver, in this context, acts as a mirror. It reflects the cost of years of financial engineering and deferred consequences. Perhaps most critically, a true silver breakout exposes the fragility of paper-based financial plumbing. As discussed earlier, paper silver markets rely on leverage, settlement flexibility, and the assumption that few participants will demand physical delivery. Rising prices challenge that assumption. As confidence in paper claims weakens, the desire for physical possession increases. This behavior is rational but destabilizing. It accelerates the divergence between nominal price and real availability. The social dimension of a silver surge is equally important. Rising precious metal prices often coincide with declining trust in institutions, widening inequality, and political polarization. Silver, historically accessible to individuals rather than just central banks, becomes a symbol of self-protection. Its rise reflects not just investor behavior, but public sentiment. That sentiment is difficult to reverse once it takes hold. History offers a clear lesson. Silver does not peak quietly. Its major moves are volatile, emotional, and disruptive. They coincide with moments when systems are forced to confront realities they have long postponed. Whether it was the collapse of fixed exchange regimes, periods of high inflation, or financial crises, silver's most dramatic advances occurred when credibility was breaking, not when it was being restored. If silver were to move into extreme price territory, the response would not be orderly. Governments would attempt to manage narratives. Institutions would adjust risk models. Regulations might change. But none of those actions create metal where there is none. None restore trust once it is lost. They merely acknowledge, indirectly, that something has shifted. This is why silver is often described as a canary in the coal mine. But that metaphor understates its role. Silver does not just warn, It forces recognition. It brings forward consequences that systems prefer to delay. When silver runs, it accelerates timelines. It exposes imbalances. It removes the comfort of gradual adjustment. In the end, the question is not whether silver reaching extreme levels would cause instability. It is whether instability is already present and silver is simply revealing it. Markets are not moral. They do not punish or reward. They reflect. And if silver is reflecting something unsettling, it is not because silver is misbehaving. It is because the underlying structure is.